At 2 in the morning, when most screens are dark and most investors are asleep, silver can still move like a living thing, snapping higher, dropping hard, and leaving behind candles that look almost disrespectful to the clean patterns drawn during regular hours. That's the overnight metal shift, where thin liquidity turns futures into a loudspeaker, and where physical demand quietly decides whether the message sticks. The number that changes the entire conversation is delivery activity. According to CME Group's daily delivery notice reporting for the current silver cycle, cumulative delivery notices have reached levels that translate into tens of millions of ounces of implied demand, contracts that can be converted into real metal through the exchange S delivery mechanism. Repeat that. This isn't only traders swapping paper exposure. The delivery process is active enough that price can't be treated as a purely technical game. Silver futures on COMEX represent a standardized contract, 5,000 troy ounces of zero, and $9.99 fine silver per full-size contract. That single fact is the bridge between price on a screen and metal that must show up. When delivery notices increase, the market is no longer just pricing sentiment. It's pricing logistics, availability, and willingness to part with inventory. And price has been moving like the buffer is getting thinner. The U.S. silver price started this year near $72, $363 per ounce on January 1st, 2026, then surged to roughly $108, $44 by January 28th, 2026. A move like that compresses months of trend development into weeks, and that compression breaks the habits built in calmer markets. In a slow trend, support forms gradually, indicators reset, and consolidations provide structure. In a fast trend, structure forms in bursts, then shatters, then forms again somewhere higher. That's why classic chart patterns start failing right when confidence gets highest. Because the underlying force isn't just momentum, it's constraint. Two different markets are operating at the same time. There's the paper market, futures, options, leveraged positioning, overnight liquidity pockets, and margin pressure. Then there's the physical market, delivery notices, warehouse flows, and the spread behavior between near-month contracts and deferred contracts. When those two markets agree, price trends can look smooth. When they diverge, price gets chaotic, especially overnight. Here's what needs to be understood about price discovery. Futures markets are powerful because they concentrate liquidity and create a global reference price. COMEX is central for U.S. benchmarks, while the LBMA plays a major role in London spot. And forward market conventions. And the Shanghai market reflects Asia's flow and policy environment through its own structure. The headline price most people quote is often heavily influenced by futures trading, especially during off hours when liquidity is thinner and price can be pushed farther, faster. That's not automatically manipulation, it's mechanics. In overnight trading, fewer participants are active, spreads widen, and order books get thinner. One large order, especially a market order, can sweep levels and print a move that looks like an earthquake on a 1-minute chart. But here's the twist. Overnight moves don't always mean much on their own. What matters is whether the physical side confirms them. Confirmation doesn't arrive as a neat candlestick pattern. It arrives as delivery interest that doesn't fade, and as inventory behavior that suggests metal is being pulled toward deliverable channels or being guarded. That's where the distinction between registered and eligible inventories matters. Registered inventory is deliverable against futures contracts. Eligible inventory meets specifications, but is not registered for delivery. The total ounces sitting in approved warehouses can look large, but the deliverable slice can be much smaller, and the willingness to convert eligible to registered can change quickly depending on incentives, spreads, and perceived scarcity. That willingness, more than the raw total, is often the early warning signal. Now, step back and look at what just happened in late January. Gold surged into the mid-5,000s, with widely reported record highs around $5,500 to $5,600 before a sharp pullback on January 29th, 2026. Silver followed the same rhythm, ripping higher, then dropping hard in a single session, with prices reported falling back toward the $109 area after trading near the high 110s. That kind of swing is not a footnote. It's a warning that volatility is the price of admission. Volatility doesn't mean the thesis is wrong. It means leverage is present, maybe too present. This is where conventional wisdom gets it wrong. Many people see volatility and assume the trend is unreliable. But in metals, especially silver, volatility can be the sign of tightness colliding with leverage. Tightness pushes prices higher as real demand persists. Leverage amplifies both directions, creating violent drops that feel like the end, followed by equally violent rebounds that feel impossible. That's the pattern break environment. And it's not new. History has two bookmarks that matter here. One is January 1980, when silver spiked to nearly $50 per ounce and then collapsed, carving one of the most infamous boom and bust arcs in commodity history. The other is March 2020, when markets across the board faced a liquidity shock and logistics stress, and the gap between screen prices and real-world availability became more visible. The point isn't that today is identical to either moment. The point is that when liquidity fractures and demand behavior shifts, markets stop behaving politely. Now bring in the supply and demand reality. Silver is both monetary metal and industrial metal. It isn't just held, it's consumed. It goes into electronics, solder, medical applications, chemical catalysts, and critically, solar supply chains that require reliable inputs at scale. When industrial demand is strong, it doesn't pause politely because an oscillator is flashing red. According to widely circulated summaries of the Silver Institute's reporting, the global silver market has posted large deficits in recent years, with figures cited around a 148. 9 million ounce deficit in 2024 and industrial demand estimated in the high hundreds of millions of ounces. Industry coverage has also cited total annual demand around 2 billion ounces, with mine production around the mid 800 million ounce range, numbers that highlight the structural issue. Mine supply alone doesn't meet demand. The difference must come from recycling and above-ground stocks, and from willingness to sell. That willingness is the hinge. When prices rise slowly, willingness to sell increases. When prices rise explosively, willingness can decrease because sellers start waiting for higher prices, and buyers start pulling forward purchases out of fear of even higher prices. That creates a feedback loop that doesn't show up as a chart pattern until it's already underway. This is the part that should make you pay attention. Physical demand can turn a normal dip into a trap for shorts. In a classic technical environment, a sharp drop breaks support, triggers stops, and price drifts lower until a new base forms. In a physically reinforced environment, a sharp drop triggers forced selling. Then the physical bid steps in, absorbs supply, and price snaps back before the clean base ever forms. That's why the overnight tape feels like it's breaking the rules. Now translate the current move into technical landmarks. Because technical analysis still matters, it just needs adjustment. Round numbers matter more in fast markets. $100 is a psychological magnet. $110 is another. The $118 to $120 zone becomes a memory ceiling because it represents the recent extreme. In a high-velocity trend, the market often revisits round number milestones, sometimes violently, because they attract both defensive flows and opportunistic flows. There's also the matter of retracement zones. From the early year low near $72 to the late January high near $118. Common retracement areas cluster around the low hundreds, the mid to high 90s, and the low 90s. Those are not predictions. They are reference points, areas where past behavior suggests the battle between forced selling and opportunistic buying tends to concentrate. Indicators like RSI can stay elevated for longer than expected. Moving averages can lag so far behind that mean reversion becomes irrelevant in the short run. In trends like this, the market can stay overbought, then become more overbought, then correct in a single brutal move that wipes out weeks of froth in hours. That brings the conversation to the bearish case, because pretending there is no bearish case is how people get hurt. First, leverage risk. A move from the low 70s to the high 110s in under a month invites crowded positioning. Crowded positioning means fragile stability. If margin requirements rise, or if price drops sharply overnight, forced liquidation can cascade. A cascade doesn't care about fundamentals. It sells because it must. Second, policy and exchange risk. Futures exchanges can raise margins. Liquidity providers can widen spreads. Risk desks can cut limits. Those changes reduce leverage and often trigger selling pressure, especially when liquidity is already thin. Third, demand destruction and substitution risk. Industrial buyers are not infinite price takers. At high prices, some purchases can be delayed, substituted, or rationed. That doesn't solve long-term tightness, but it can create short-term error where price falls faster than expected. Fourth, macro reversal risk. If the dollar strengthens sharply, metals can face headwinds. If geopolitical risk fades suddenly, safe haven flows can unwind. Gold cooling often cools silver even harder because silver tends to amplify the direction. And finally, technical rejection risk. When price tags an extreme level, like the high 110s, profit-taking can become self-fulfilling. A sharp rejection can retrace toward $100 faster than most people expect, and it can do it in the overnight session when liquidity is thinnest. All of that is real. But here's what those risks don't change. If physical demand is persistent, the downside can be limited in ways that break expectations. Persistent physical demand changes the character of pullbacks. It turns dips into stress tests rather than trend killers. It forces the market to find sellers who are willing to part with metal, not just traders who are willing to close a position. That's why the plumbing matters so much. Delivery notices, warehouse flows, and curve structure. Curve structure is where the market whispers the truth. When near-month contracts trade at a premium to deferred months, that can signal tightness, sometimes described through backwardation. Backwardation is when the spot or near-month price is higher than the future price, often reflecting urgent demand for immediate delivery. Contango is the opposite. Future prices higher than spot, often reflecting carrying costs like storage and financing. The basis, roughly the relationship between spot and futures, can also signal stress when it behaves unusually. These terms sound technical, but the intuition is simple. When the market is comfortable, it pays extra for time. When the market is uncomfortable, it pays extra for now. Now add the global context. Silver doesn't trade in isolation. It trades in a world of shifting currency confidence, shifting geopolitical risk, and shifting industrial policy. Asia's physical flows matter. Europe's regulatory environment matters. The US futures market matters. And retail participation matters more than many people think, because retail participation can add reflexive volatility, especially when products and contract sizes become more accessible. More accessibility can deepen liquidity over time. Yet, in the short run, it can also increase the speed at which emotion hits the market. When a milestone like $100 gets crossed, new participants arrive. Some buy because of conviction. Many buy because of excitement. Excitement is fragile. That fragility is why patterns break. Here's where it gets really interesting. Overnight volatility can actually become a signal rather than noise. In a calm market, overnight noise is mostly irrelevant. In a stressed market, overnight prints can reveal where the weakest liquidity pockets are and where the most aggressive players are willing to attack. If price repeatedly spikes or breaks levels overnight, and then gets bought back during the day, that can indicate that leverage is trying to force the market down, but real demand is absorbing it. If the opposite happens, if overnight rallies fade and daytime selling persists, that can indicate that the market is losing its physical reinforcement and reverting to a purely speculative tape. So the job is not to worship the overnight candle. The job is to watch whether the overnight candle gets confirmed by follow-through, by spread behavior, and by ongoing delivery engagement. And that leads to practical, actionable monitoring without needing insider access. Start with the exchange's own reporting. CME Group publishes delivery notices and operational details that reveal how the delivery process is functioning. Those numbers are not social media estimates. They are the formal record of the mechanism. Then watch warehouse updates and pay attention to whether registered inventory trends change meaningfully. The total can remain large while the deliverable portion tightens. In a stress regime, that matters more than the headline total. Then watch premiums in the real world. Retail products, wholesale tightness, and any persistent divergence between spot quotes and actual acquisition costs. Premiums are where availability speaks. Finally, watch macro catalysts that hit overnight. Geopolitical developments, currency swings, and sudden repricing of rate expectations. Those catalysts are gasoline on a thin liquidity fire. Now, zoom in on the human side, because markets are data and psychology at the same time. In a fast silver market, different audiences experience the same move differently. For physical holders, the key challenge is emotional discipline. A 5% to 10% daily swing can happen without changing the long-term picture. The job is to avoid letting overnight volatility rewrite a long-term thesis every 12 hours. For traders, the key challenge is survival. Stop placement, position sizing, and respect for overnight gaps matter more than perfect entries. In a market like this, the right idea can still lose money if risk is mismanaged. For long-term investors, the key challenge is separating structural signals from short-term noise. Structural signals come from deficits, industrial demand, and persistent delivery engagement. Short-term noise comes from liquidation cascades and headline-driven whipsaws. For new participants, the key challenge is avoiding the belief that silver is a straight line. It is not. Silver is a staircase that sometimes collapses into an elevator shaft, then reappears higher later. That's why education matters before exposure. And now, do the dots connect? The overnight metal shift is not a mystery. It is what happens when futures markets, built for liquidity and hedging, collide with a phase where physical demand becomes more influential, and where the availability narrative matters more than usual. Physical demand doesn't announce itself with a catchy chart pattern. It shows up as persistence. Persistence in delivery behavior, persistence in premium behavior, persistence in the market's refusal to stay down after forced selling. That refusal is what breaks the neatness of technical analysis, because technical analysis is most comfortable in equilibrium. And this is not equilibrium. This is the market testing the limits of its own pricing mechanism. Now, pause and consider a simple question. What happens if physical demand remains strong while the market keeps trying to reset leverage through sharp drops? The answer is not guaranteed higher prices. Nothing is guaranteed. The answer is higher volatility and repeated attempts to shake out participants, with the potential for asymmetric moves when supply becomes less willing to meet demand at the old price. That's why this moment matters now, not later. If delivery engagement and physical tightness continue, the market can keep breaking the expected pattern playbook. If delivery engagement cools and premiums soften, the market can revert to a more normal technical rhythm, where pullbacks last longer and indicators regain usefulness. The difference between those outcomes will be visible in the plumbing before it becomes obvious in the headlines. Do not take any of this as a call to buy or sell. This is market education, how the mechanism works, how to interpret data, and how to think about risk. Precious metals are volatile, and silver is capable of rapid, violent moves in both directions. Leverage can erase capital quickly. Independent verification matters, primary sources matter, position sizing matters. No single indicator, technical or fundamental, protects against overnight gaps. The core message holds. If physical demand is what's driving this overnight metal shift, then the chart isn't the leader anymore. Price patterns are not the engine. Metal flow is. And when metal flow becomes the engine, expect broken patterns, expect sudden drops, expect fast rebounds, expect a market that stops behaving politely, because it's no longer only trading a number, it's trading availability.